Hi everyone! Last week turned out to be a losing one for the equity market. All three benchmark indices dipped by about 3%. A similar drop occurred a week ago. The NASDAQ extended lesser losses, declining by 2.6%. However, it can hardly be called a positive factor. The stock market has been steadily decreasing for a while. So analysts predict new lows. No matter how much investors try to improve market sentiment, desperately looking for some positive news, it will hardly change the situation. So far, there have been only short-lived reversals. After a slight recovery, stocks again lose ground. They also decline rather sharply, approaching new lows. The new month and the new quarter have begun. It's still difficult to assess the prospects of the market after September, historically the worst month for the Wall Street. The bearish trend prevails. The current downtrend correction is the longest since March 2009, as it has been lasting for more than 250 days. According to the DJIA investor sentiment survey, 60% of respondents are pessimistic about stocks. This is the highest reading since 2008 and the 8th pessimistic indicator in 35 years of the survey. Therefore, bears are unlikely to lose the upper hand in the near future. Let's discuss the highlights of the last week and talk about the upcoming events in the stock market. The new week kicked off with uncertainty. Wall Street managed to return to positive territory on Monday, yet it does not mean anything. As a rule, short-term upward reversals wane quickly. Hence, the bearish bias is strong. This week, China may help stocks slightly recover. The country is celebrating the anniversary of the founding of the People's Republic of China. The holiday will last for a week. As trading floors are closed, there will be no negative news or reports from China this week. Wall Street investors will largely focus on fresh economic data, especially the publication of the non-farm payrolls report on Friday. On Wednesday, the ADP report is due. The economic calendar is not eventful this week. Traders are going to digest the upcoming reports and deal with their fears and expectations of a recession and inflation in the United States. This week could be lackadaisical, with stocks making feeble attempts to find the bottom. However, these attempts will hardly be successful. Currently, stocks are dropping to new lows, so the bearish trend is sure to dominate. What's more, the earnings season is around the corner. Some analysts believe that the new quarterly report may help stocks rebound and set a new long-term trend. Last week, the main stock indices did not react to the correction of the US dollar. It appears they are not sensitive to changes in the US currency. They are vulnerable to key rate decisions, fluctuations in government bond yields, and risk sentiment. These factors remain rather unfavorable for stocks. If nothing changes in the coming days, there could be a further downward slide. Like other stock indices, the Dow Jones closed in the red, posting weekly, monthly, as well as quarterly losses. In the third quarter, the Dow fell by 6.7%. Notching a three-quarter losing streak for the first time since 2015. The S&P and NASDAQ indices sank by 5.3% and 4.1% respectively, showing the third consecutive negative quarter for the first time since 2009. On Monday, the Dow rose by more than 600, while the S&P and NASDAQ gained 2.1% and 1.7% respectively. Large traders entered the market and managed to halt the sell-off triggered by the Fed's hawkish rhetoric. After a series of disappointing inflation reports and hawkish comments by several Fed policymakers, investors have realized that interest rates are likely to remain high for longer, even with the risk of recession. Interest rates are projected to reach 4.6% next year, as the Fed will not make any rate cuts until 2024. Thus, expectations of a shift to a dovish stance waned. A rise on Wall Street at the start of the week caused a decline in the government bond yields. The likelihood of a slowdown in the US and global economies has increased expectations that the Fed could stop raising interest rates. Investors seem to repeat the same mistakes. Sooner or later, they will have to face the brutal truth. The latest report signaled a slowdown in economic expansion. The manufacturing PMI index for September grew at the slowest pace in almost 2.5 years. The ISM Services Business Activity Index fell more than expected to 50.9 from 52.8 in August. Traders will receive additional hints about key rate hikes after the release of Friday's NFP report. The number of new jobs are likely to decline. The economy is expected to add 250,000 jobs. The unemployment rate may remain unchanged at 3.7%. The S&P 500 index lost 2.9% last week. Friday was the worst day, with the index sinking by 1.5%. Among other things, pressure on risky assets was exerted by increased geopolitical tensions in Eastern Europe after the referendums of joining Russia of the DRPR, LRP, Kherson and Zaporozhye regions. The worsening energy crunch in Europe was also weighing on the sentiment. Apart from that, the UK bond market was rather volatile following the announcement of tax cuts. As a result, the US stock indices, in particular the S&P, have broken through important support level. The S&P was consolidating at 3,600 during the week, but eventually tested a new 52-week low of 3,585. Even though it managed to bounce back yesterday, there is a little hope for further recovery. The consolidation phase seems to have ended. The technical outlook for the S&P is also bearish. Some analysts assume that a fifth wave of the downward movement has begun in the market. If so, the index may slump to about 3,200. The lows of September 2020 are located near this level. In the meantime, speculators should pay attention to the first bearish target level of 3,500. If the index approaches this level, it will open the way to lower levels located at least at 3,400, 3,300. Such a scenario may come true if recession and inflation fears intensify. In this case, even technical analysts will be useless if it suddenly indicates a reversal pattern. The trajectory of the heavy tech NASDAQ also signals the continuation of the bearish trend. Monday's moves looks more like a short-term correction or breather in the fall. At the start of the week, the correction of the NASDAQ was less noticeable compared to other benchmark stock indices. The main reason could be disappointing news from Tesla. The company announced its delivery and production numbers for the third quarter, which turned out to be 4% lower than expected. However, Tesla delivered almost 344 electric vehicles, a record for the world's most valuable automaker. As our production volumes continue to grow, it's becoming increasingly challenging to secure vehicle transportation capacity and at a reasonable cost during these peak logistic weeks, Tesla CEO Elon Musk said. The company may not be able to achieve its ambitious target to increase production by 50% this year due to logistic problems. Tesla shares took a nosedive by 7.4% to their lowest level since mid-summer. Viasat was among the biggest gainers. Its shares soared by 21% in the pre-market. After that, they kept rising. Such a spike was facilitated by the company's announcement about the possibility of selling its tactical data link business for $1.8 billion. Last week, shares of companies in the manufacturing sector incurred huge losses. Only 2 sectors out of 11 closed the week in the green. The energy and commodity sectors were able to add 1.86% and 0.92% respectively. Shares of companies from the medicine and healthcare sectors also scored gains. However, only stocks of individual companies advanced, not the whole sector. In general, the average losses in this sector totaled 0.67%. Shares of small biotech company Bluebird Bio showed the best performance. Last Friday, they rose by more than 11%. In a week, The capitalization of this company grew by almost 20%. That's all for now. Subscribe to our channel and keep your finger on the pulse. Feel free to leave your comments down below. See you!